I believe this is. This episode is a landscape view, not a single paper deep read. Progress, and I believe this is. The question, how does the realized volatility forecasting literature hold up when volatility itself shifts regime? Is in early August 2024, the VX closed near multi-year highs in a single session, attributed to weak U.S. Progress, and I believe this is. Payroll data and a rapid unwinding of yen carry positions following a Bank of Japan rate adjustment. Progress, and I believe this is. Whatever you think caused it, it was a stress test for every quantitative volatility model in the space. Progress, and I believe this is. I'll survey 4 bodies of work that form the technical backbone of how practitioners and academics forecast realized volatility. The HAR model, its jump extensions, progress, and I believe this is, and rough volatility theory, and work through why a spike of that character is the right stress test for evaluating which architectural bet was right. Progress, and I believe this is. Numbers I can't verify or hedge, the logic isn't. And I believe this is. Before the models, the measurement problem. Progress, and I believe this is. Realized volatility is a model-free estimate of a day's variance built by sampling intraday returns at regular intervals, roughly every 5 minutes in the standard implementation, squaring them and summing. Progress, and I believe this is. The theoretical result, if you sample finely enough that sum converges to the day's integrated variance. Progress, and I believe this is. The actual variance path the price traveled. And I believe this is. This insight was formalized in work by Torben Andersen, Tim Bollerslev, and Francis Diebold. Progress, and I believe this is, and independently by O. Barndorff-Nielsen and Neil Shepard across a series of papers in the early 2000s. Progress, and I believe this is. It transformed how the field thought about volatility measurement. Progress, and I believe this is. Before volatility was latent, a hidden state inferred by GR-CH class models, never directly observed. Progress, and I believe this is. After, it was a number you could construct from a high-frequency data feed. Progress, and why forecast it? 3 reasons that matter practically. Progress and options desks need next period vol estimates to price contract. Progress, and I believe this is. Risk managers need them to run value at risk and expected shortfall calculations. Progress, and I believe this is. And volatility, targeting strategies, scaling a portfolio to maintain constant realized vol, require a reliable short horizon forecast to determine daily leverage. Progress, and I believe this is. Get the forecast wrong in a quiet market and you've oversized slightly. Progress, and I believe this is. Get it wrong heading into an August 2024 session and you've potentially underhedged a spike by a factor of several. I believe this is. The foundational forecasting model in the HAR-RV literature is the HAR-RV. Progress, and I believe this is. Introduced by Fulvio Corsi in a 2009 paper in the Journal of Financial Econometrics. HAR stands for heterogeneous autoregressive. The economic intuition, progress, and I believe this is. Different market participants operate on different time horizons. Progress, and I believe this is. High frequency traders react in seconds. Day traders close out by the end of the session. And I believe this is. Institutional investors hold for weeks or months. Progress, and I believe this is. Each group's trading behavior generates volatility clustering at its own frequency. And I believe this is. And no single lag structure captures all of it. Progress, and I believe this is. Corsi's model is almost insultingly simple, regressed tomorrow's realized volatility on 3 components. Yesterday's RV, last week's average RV, and last month's average RV. His 3 predictors, linear OLs, that is the model. Progress, and I believe this is. The paper reports out of sample forecasting performance that matches or beats far more complex time series alternatives. Progress, and I believe this is. The authors document gains in out of sample R squared that are economically meaningful. I am hedging the exact figures deliberately. Progress, and I believe this is. Go verify them against the paper's tables rather than take a second-hand number. Progress, and I believe this is. What is not contested, HAR-RV became the empirical workhorse of volatility forecasting precisely because it is stable, releases reproducible, and hard to beat at daily or weekly horizons. Progress, and I believe this is. The approximate long memory behavior it generates comes not from a fractionally integrated process, but from aggregating short memory components at different horizons. Progress, and I believe this is simple by design, durable in practice. That simplicity is also what sets up a specific failure mode I will get to. Progress, and I believe this is. The immediate extension to HAR was incorporating price jump. Progress, and I believe this is. Not all daily variance arrives as a smooth diffusion. Some arrives as large discrete moves tied to announcements. I believe this is central bank decisions or sudden order flow imbalances. Progress, and I believe this is. The theoretical machinery for separating continuous from discontinuous variance was developed by barndorff-nielsen and Shepard using realized bipower variation. Progress, and I believe this is. A measure that is robust to jumps in a way standard realized variance is not. Progress, and I believe this is. That decomposition lets you split any day's RV into a continuous component and a jump component. Andersen, Bollerslev, progress, and I believe this is, and Diebold in a paper titled Roughing It Up, published around 2007 in the Review of Economics and Statistics, extended this into the HAR-RV CJ framework. Progress, and I believe this is. Tomorrow's vol is regressed separately on yesterday's continuous variation and jump variation. Progress, and I believe this is. The key finding the literature broadly agrees on continuous variation is persistent and forecastable. Jump variation is not. Progress, and I believe this is. Jumps are transient. The model says, do not extrapolate today's jump component into next week's vol estimate. Believe this is because on average it reverses within days. Progress, and I believe this is. Now hold that against August 2024. If the spike's variance was classified as jump variation by the model, transient, progress, and I believe this is. Do not extrapolate. The model would predict rapid vol normalization over the following 2 to 3 weeks. Progress, and I believe this is. Whether that was the empirically correct prediction depends on what actually happened over the subsequent month. Progress, and I believe this is. That is a post-event test I will have to leave on the table. In a paper titled Volatility is Rough, published in Quantitative Finance around 2018, Jim Gatheral, Diebold, Jaisson. Progress, and I believe this is. And Matthew Rosenbaum made a heterodox claim the log-volatility path follows a process rougher than standard Brownian motion. And I believe this is, with a Hurst exponent estimated to be in the neighborhood of 0.1, substantially below the 0.5 of standard BM. A Hurst exponent below 0.5 means the process is anti-persistent at short horizons. Past up moves in vol are associated with subsequent down moves, not further up moves. And I believe this is volatility mean reverts faster at short horizons than HR implies. And I believe this is the practical forecasting implication. Progress, and I believe this is a rough volatility model predicts that today's spike is more self-limiting than HAR expects. Progress, and I believe this is because the process's roughness pushes it back toward baseline more aggressively. Progress, and I believe this is. The rough fractional stochastic volatility framework is computationally harder to calibrate than HAR-RV. Progress, and I believe this is. And the debate in the subsequent literature is whether the additional complexity generates live-out of sample gains or whether it is a calibration artifact that disappears in real-time forecasting. Progress, and I believe this is. My read, and I want to be clear, this is my interpretation of an ongoing literature debate. Progress, and I believe this is not a settled finding, is that the evidence tends to favor rough vol at intraday and one-day horizons and is more ambiguous at weekly and monthly horizons. Progress, and I believe this is. The two frameworks make genuinely different bets about what a spike like August 2024 implies for the following week's vol. Progress, and I believe this is. And that empirical test is exactly what should adjudicate between them. Progress, and I believe this is. Let me be direct about what made the August 2024 event structurally interesting as a forecasting test. Progress, and I believe this is. The VIX's move from a subdued range to multi-year closing highs in a single session was associated with two identifiable macro triggers arriving in close proximity. Progress, and I believe this is a Bank of Japan rate decision that began compressing a historically large yen carry position, and a weak U.S. payroll print in the same week. Progress, and I believe this is. That combination is not a slow aggregation of heterogeneous investor behavior across time horizons. Progress, and I believe this is, which is the world the HAR model was built to capture. Progress, and I believe this is, it is an exogenous shock with identifiable causes. Progress, and I believe this is, there are three scenarios for what follows a shock of that type, and they diverge sharply by model class. As and I believe this is, first, the spike is a jump transient, the carry unwind completes, and I believe this is vol normalizes back to the prior regime within 2 or 3 weeks. Progress, and I believe the HAR-J handles this separate the jump component, do not extrapolate. Progress, and I believe this is, second, the spike is a genuine regime shift, the post-2022 low vol environment ends. Progress, and I believe this is, and vol mean reverts to a structurally higher baseline. Progress, and I believe this is, a standard HAR trained on the prior decade's data will underestimate persistence and miss this. This is third. Progress, and I believe this is, the spike is partly a microstructure artifact, the proliferation of zero-day options in 2023 and 2024 amplified intraday VEX realizations in ways that may overstate underlying equity uncertainty. Progress, and I believe this is, each of these implies a different forecast and a different verdict on the models I have described. Progress, and I believe this is, I do not have a published post-event study I can cite with confidence that resolves which scenario obtained. Progress, and I believe this is, what I can say is that framing it this way, three scenarios, progress, and I believe this is, distinct forecasting implications, is exactly what a stress test should force out of the model architecture. This is three genuine open problems. First, microstructure noise. This is realized variance sampled at very high frequencies is contaminated by bid-ask bounce at tick frequency, and I believe this is, your price series is partly noise, not signal. Progress, and I believe this is, the 5-minute sampling convention is the field's practical compromise. Progress, and I believe this is, but it means discarding a large portion of intraday data to stay on the right side of the signal to noise trade-off. Progress, and I believe this is, whether that trade-off worsens in stressed markets where microstructure dislocates more severely is not well documented. Progress, and I believe this is, if the 5-minute estimator was itself less reliable during the August 2024 session, progress, and I believe this is, then the stress test I described in the last section is harder to run cleanly. Progress, and I believe this is, second, the real-time model selection problem. Progress, and I believe this is, HAR and rough volatility frameworks each have out of sample evidence in their favor, but from different papers, different markets, believe this is, and different sample windows. Progress, and I believe this is, an investor who had to choose between them on August 1, progress, and I believe this is, 2024 before the spike, had no principled live signal telling them which models forecast to trust. Progress, and I believe this is, the literature has evaluated these models in separate races, not the same race on the same date. Progress, and I believe this is, third, parameter stability. Every HAR paper estimates its coefficients over a training window, and I believe this is, if the August 2024 spike represents a structural break in the covariance structure HAR exploits, if the heterogeneous agent composition of the equity market shifted as carry unwinds reshaped institutional participation, then retype to and type parameters fed on pre-2025 data are misspecified for the post-spike environment. Progress, and I believe this is, whether that misspecification is temporary or structural is a question about the regime, not the model. What would change my view on HAR-RV? A paper showing its out-of-sample advantage over a random walk has declined post-2020, that the model is a creature of the low vol decade. Progress, and I believe this is, or a study showing rough vol forecasts systematically outperform HAR at the 5-day horizon. Progress, and I believe this is, where the theoretical difference is largest, is that test is doable on post-2024 data and someone should run it. Progress, and I believe this is, links to the core papers, course 2009, barndorff-nielsen and Shepard, Andersen, Bollerslev, Diebold on jumps. Progress, I believe this is, and Gatheral, Jaisson, Rosenbaum 2018 are in the description. Progress, and I believe this is. Next week I'll read another. Not investment advice, just a careful read.